returns and aligning investor and manager interests for lasting growth. So, Carter?
Excellent. All right, thank those of you who stuck around for the last presentation of the conference. As I said, I'm Carter Coe. I'm a managing partner at Chinook Forest Partners. We are a niche timberland investment manager, investing in about, right now, 250,000 acres throughout Oregon and Washington. Today I'm going to be talking about aligning investor interests with manager interests to try and figure out how do we achieve maximum outcomes for both parties. This is something that's interested me for a long time. I hope it interests some other people in the room. It's kind of like a legal discussion, but hopefully with a spin on some historical examples that I've experienced throughout my career. And I should note that there's people in the room, I think, that were at the Portland conference, the Canopy conference in September. This is very similar to a panel that I did with Chris Martin from APG, Charles Hugo LaJeunesse from CDPQ, Tom Goodrich from Lime Timber, and Hill Jeffries from Evershed Sutherland. So they helped to contribute to the content. So it's coming from LPs, GPs, from a lawyer, a very well-respected lawyer, and from me having experiences both on the LP and the GP side. So I'm going to jump into first an introduction. Sorry, this is not the most recent version of the PowerPoint, but that's okay. Jump into an introduction, and then the topics of alignment, transparency, and integrity, followed by a case study that brings these together holistically for this discussion, and then a Q&A. Spawning Chinook, an introduction to the company, is founded in 2018 by my two business partners, Scott Marshall and Kelly Droege. Scott coming from MetLife, Kelly Droege coming from International Woodland Company, and then I joined shortly after from Stafford Capital Partners. All of us sitting in unique roles where we got to see under the hood of the entire timberland investment industry. I think a really unique situation, literally touching, at the time, I think almost every single manager in some way, shape, or form, and being able to develop opinions on what was working and what was not working, at least for some segments of the institutional investor community. And some of that evolved out of the NCREIF Timberland Index chart there on the right, the compressing of returns coming out of the global financial crisis. So the timberland investment asset class, of course, did really well in the 90s and early 2000s, not so much in the years that followed, especially 2010 to 2020 timeframe, where you had this compression of returns. And at least what we saw was that this larger segment of the investor community was asking for a higher touch, more direct feel to the timberland investment management approach. And not just from a lower cost perspective. They wanted higher alignment, transparency, and integrity. Really feeling like the team members at the manager were part of their team, wearing their hat every day, not wearing just their own hat. And a Danish pension fund took a chance on us in early 2019, kind of a maverick in the industry, deploying capital with a manager with no track record, and put us off to the races. So I want to start off with the topic of alignment. Are we all rowing in the same direction? And I think you all understand I'm not just talking about the owners of a TMO and the employees of that TMO. I'm talking about the owners and employees of the TMO alongside the investor. Are we rowing in the same direction, all of us? Or are we going in different directions? And you're probably wondering, why do I have a picture of a chiropractor and a shirtless man up here at a Timberland investment conference? But there's, I think, a decent reason. Literally, my chiropractor is trying to provide me with alignment every day, or every week or 2 weeks, to improve my low back pain. Figuratively, he and I are not at all aligned. His best interest is for me to have low back pain for the rest of my life, so that I come back every 2 weeks, every month, and he has an annuity on me for the rest of my life. So we're clearly very much out of alignment. I like the guy, I really do, but we're out of alignment. And it's just an illustration of the broader problem of misalignment in all industries, but certainly this industry being an example. And I think more so than other private equity asset classes, because it's a longer hold and lower return. So the carried interest in particular does not work very well, or at least historically has not worked very well in terms of aligning investor and manager interests. And when we think about alignment and generating structural alignment, we think about these 7 topics around this central theme. Of course there's others, but these are the 7 ones I want to talk about today. Carried interest, investment management fee, and GP co-investment being the financial incentives that really kind of drive the engine of day-to-day performance thinking, acquisitions, dispositions, and operational performance. I think the carried interest investment management fee is one of the most interesting discussions in this asset class, at least since I came into it in 2010, because lower returns have kept managers out of the money, and they haven't seen a way back into the money, at least from 2010 to 2020, not as much so the case now. And it has been very hard for the investment management fee to be anything other than the primary motivation for the manager. I saw this in my prior roles. I certainly experience it now. So it's not throwing a grenade at everybody else and pointing the finger. I'm exposed to it. I have to deal with this misalignment too. It's just a difficult thing to deal with when the carried interest is not more powerful than the investment management fee. And even in the case when you are in the money, oftentimes maybe it's 2 to 3 times investment management fee. Is it better than holding assets for 5, 10 more years? So you get these kind of pretend and extend, buy and hold situations, gathering of AUM, and it makes it really hard to kind of balance the interests of investors and managers. The GP co-invest, of course, can help to balance that out, but who's exposed to it? If it's just a big allocation from an institution backing up the manager and not coming from individuals, does it really have any power? Yes, I'm sure it does through bonuses and such, but ideally, this would be coming from those making acquisition and disposition decisions, performance-related decisions over the hold of the investment, just as would be the case with the carried interest component of this. Investor ownership of the GP, this I don't think was very common in prior decades, more common across private equity in recent years, and something that we've been exposed to. This certainly provides an investor with increased transparency into the day-to-day decision-making at the manager. So not necessarily influencing decision-making from a financial perspective for the manager and the individuals running the team, but at least gives the investor more insight under the hood of the manager. Key person and GP removal language, I would think and hope that every single IMA and LPA in the industry has such language. More of a disincentive to bad behavior than an incentive for good behavior, as I see it, because the day-to-day, performance-driven decisions, I think, are more influenced by those 3 financial characteristics. And queuing protocols, I don't think I would have put this up here a year ago, but in talking to an investor, I've learned just how important getting these queuing protocols is right for those of us that manage multiple investors' dollars and assets across this asset class. You can, if these are not developed, divert deals to one investor who's maybe paying more fees than another. Good deals going to one, bad deals going to another. It's got to be very clear to make sure that everybody's aligned. Property management, this could have been on the last slide, but I think of property management a bit differently than I am in terms of the alignment discussion, but it's just as important as investment management fee. This is not a discussion about what's the best way to provide the property management service. I heard that since I went to graduate school in 2010 in this industry, arguing over which one's the best. That's not it. I think it's a matter of, do you have a good property manager, and is there transparency on the services and how they're charged through to the investor, which is not always clear. Common structures being outsourced, vertically integrated, and portfolio owned or zero margin type approaches. The outsourced, I think it's fairly simple to diligence. You're working with a Landvest, AFM, F&W, FRC, outsourcing services to them. Usually I think they're pretty transparent about their cost of services and how they layer on a margin, so it's very clear. One caveat is, I've never seen this, but I have heard that it has happened, where investment managers may layer a margin on top of the property manager's margin. I don't think that's appropriate except in extenuating circumstances. Vertically integrated, where the manager owns the property manager, of course, can work well. It's a captive team to the investment manager, can work great for the investor. It also cannot work well for the investor if there is not transparency on how those services are being charged through and how much margin, profit margin, is coming from property management versus investment management. Finally, the portfolio owned or zero margin approach. This is what we do through our subsidiary, Chinook Forest Management. I'm not here to say that this is the best approach. It has its issues as well, but that is how we provide the service, just as a pass-through of the cost. It can be more expensive if there's not rigor around budgets and costs, though. So you just have to be careful of understanding that as an investor. Regardless, proximate assets are going to be difficult to manage conflict. If you've got 3 investors invested in one wood basket, how do you make sure that log prices are not being affected more positively or negatively for one versus another? Very important to understand that in the property management discussion. Transparency. Okay, again, another picture. Why is this up here? This is one of the most beautiful lakes I've ever seen in southwest Colorado, the San Juan Mountains. Did a hike up to this last summer with my father-in-law, and I think it's an illustration in nature of how inspiring radical transparency can be. Obviously, this water is transparent as it gets, and I think radical transparency in investment management generates the same level of inspiration. A CIBC survey several years ago illustrated just this point, even beyond my wildest imagination. Transparency was noted as the most important thing to LPs in this survey, even higher than lower IM fees, which would suggest, I think, that investors, at least some, might actually pay another 5 or 10 basis points IM fee for a radically transparent manager. So we take an open book approach where nothing is proprietary. And I can understand why managers would not take this approach. I've been in situations certainly where I am aware that competitive information is being shared with an investor who works with other managers, and it makes me feel vulnerable. Nonetheless, that's the approach that we think is best and actually makes the manager better. Because when the investor can see everything, can see under the hood, they can provide feedback in a way the other ways cannot. And we've been in some situations, like I say, where we feel very vulnerable, but the feedback that we get makes us better. Now, why do I have this Excel file on the right with some formulas there in the bottom right? So I'm using this to illustrate something that an investor brought to my attention that I never thought of as being an example of lacking transparency, but I now understand how it does. At one time in my career, I would send hard-coded underwriting models to investors because I felt like I don't want them to be able to understand exactly how I got to this. I want them to ask the question, and then I can curate how I'm going to respond to that. Well, obviously, that lacks transparency. And that was interesting to have that brought to my attention, but we always try to provide full Excel files when we're providing those to investors as a result of that feedback. Another example of lacking transparency I thought was interesting from this same investor mentioned that he had seen deal teasers that were rebranded, like Landvest, Perella Weinberg, AFM. They send a deal teaser and then it's rebranded to look like an off-market transaction from a manager. It's silly. I mean, it lacks transparency. Bad news does not age like fine wine. I heard this quote several months ago and thought it was great. It's not usually the bad news that gets us in the most trouble. It's the hiding it. We went through a situation several years ago where an IM fee was overcalculated for about 2 to 2.5 years. Incredibly embarrassing, but being transparent, bringing that to the investor's attention and dealing with it as transparent as possible was huge. Transparency may not work if we believe our own BS. I put this up here recognizing I sit in the echo chamber, I have my own BS. From 2010 to 2020, I believed a lot of things that didn't come to fruition. Maybe something like U.S. South timber price appreciation, assumptions around that, and the belief, almost a God-given right, that U.S. South landowners would see timber price appreciation from 2010 to 2020. And it takes an investor being able to sniff out how much is the manager just sitting in their echo chamber versus this being a transparency issue. Can transparency go too far? Yes, it can. I've caught myself discussing $5,000 to $10,000 expense items with somebody that's deployed $200+ million. It's a total waste of time. So radical transparency is not inspiring when it gets to that level. Finally, transparency often decreases for smaller allocations, at least in private markets. I have seen retail investors do okay in a private vehicle, but I've also seen a pretty bad outcome for retail investors in a private timberland investment where management fees were way higher than standard, and the acquisition process and operation of the investment was very poor. So I don't think it's suitable for retail investors in most cases. I think public market investment is better. Integrity. I think integrity underlies the whole discussion, because without integrity, how do you have transparency and alignment? Nonetheless, it's about as hard to due diligence as anything for an investor, or at least that in my case has been my determination. I like the idea of using something like personality tests or even lie detector tests if we lived in a different world, but nobody's going to use that, and even if they could, like a personality test can obviously be gamed. So drop it down to the trust your gut. This can work, obviously. I was in an experience about 10 years ago where a C-suite executive at MetLife went and visited 2 investment managers on a trip two that they had invested with in a big way, and came out of one meeting, said, this guy, I believe everything he's saying, he's great, I want to do as much business with him as we can. Had nothing to do with performance. It was just, he trusted him, he liked what he was saying. Came out of the meeting with another manager, said the exact opposite. Nothing about performance, I don't believe what they're saying, I don't want to do any more business with them. So the trust your gut is huge. Reference calls. So this one has me puzzled based on some of the capital allocations that we see in this asset class. You have to ask yourself, are reference calls being made? But going beyond just what the manager provides for a reference call and saying, okay, manager provided me Billy Bob for my reference call, now I ask Billy Bob to provide you with another reference call to get a more rounded picture of the manager. If you're investing $100+ million on behalf of a pension fund, I think it warrants that level of reference call rigor. Greenwashing. Look, Sam Rohrbar pointed out that the ESG benefits of this asset class have been going for decades, and we didn't really tout that for a very long time. And so maybe we're owed a little bit of hyperbole the last 5 years, but taking it too far is usually obvious, and there's an integrity analysis component to that discussion. Finally, I want to point out something here that may not be popular to say, but we're in Manhattan, Wall Street's right down the way, and there on the right, got this image that says, play by the rules, get beat by those who don't. I do think it's possible to have too many high integrity people in a manager. You just need sideboards around those who have low integrity, or lower integrity, let's say. So you need to have people that understand how the Wall Street guys work and can work with them, and then have those high integrity people surrounding them. Finally, the case study that I think really rounds out the topic of governance, alignment, transparency, and integrity. I saw this a lot in my prior roles, not been personally involved in one of these for a long time, but the internal conflict continuation vehicle type transaction where a manager is taking assets from an existing manager or existing investor and transitioning those to ownership by a new investor also under their management. I really struggle with this, but I do also recognize it can be the optimum outcome for existing investors. It just has to have a lot of scrutiny around it to get it right. I don't think third-party appraisals are enough. I don't think a general consultant that spends 5% of their time on timber is enough to assess a situation like this. I think you have to have somebody like a Timberland involved for an investor to really understand, are they getting an optimal outcome on their exit or their entry into this asset class? Now, certainly the evergreen structures are a perpetual version of this, and they figured out great ways to make it happen. But I think in the closed-in structure and the SMA structure, I have a little bit more of a struggle with how this can go down. If the investor has had a great experience with that manager for 10 to 15 years, they've never had an issue with integrity and trust, it's probably going to be fine. Still needs verification. I just think this is a very interesting example of how to deal with a conflict of interest in this asset class and how it rolls together in the topics of alignment, transparency, and integrity. All right, so I'll finish off the presentation by saying, would you give you $100 million if you were a manager? And that's how we try to think about it at Chinook, how I try to think every day. Would I give myself $100 million if I had it? And am I working on behalf of the investor to maximize their outcomes while also maximizing my own? And hope there's some questions. I think that's always the most interesting part of the presentations. So if anybody has any, please go ahead. Mary Kate.
Yeah, thanks very much. We've had an interesting situation over the past year where because there's a lack of benchmarks, I would say, that are applicable really for the Timberland sector on structures and things like amount of GP co-invest, even fees to some extent. Sure, Timberland's got the insights, but they won't tell any of us them. They only tell the asset owners. We were being put up against folks saying we should have a 10% GP commitment, for example. And I mentioned it earlier, but we're 51 shareholders at FIA out of 60 people. That's a lot of money to come out of pockets that reach to our admin executive assistants. So it's just not something we can do. I just wondered, in the chat you had a Canopy elsewhere, have you run into this, like how our weird little small asset class competes when we're weird against some of these alignment things that are probably general GP/LP issues we can generally think of, and then we in Timberland are a little bit different sometimes, especially those like you or us who are not fully backed.
Yeah, so that's a great question, and something we think about a lot. I think you're specifically asking about the co-investment, is that correct?
The co-invest as an example, I think,
Yeah.
of like where we just stick out on parameters, because I'm sorry, if there's LPs in the room, FIA is not gonna ever have a 10% co-invest.
Well, I mean, unless you're, Manulife, Campbell, BTG, Nuveen, I mean, that's a tall ask. I don't understand honestly, how investors don't understand that that's too much to
I
ask.
tried, Carter, I tried. I
Of an
was like, would
employee
you
owned
like to
firm.
see my paycheck and my bank accounts, my net worth?
Yeah, I mean, on a $500 million transaction, that's $50 million. Like, that's insane. And it is a struggle to me to understand what's going on there, because to me, a 50 basis point co-invest from a smaller employee-owned firm is way more powerful than a 10% co-invest from an institutionally backed TMO. Not to say that either one can't create optimal performance for the investor, but I think just in terms of the power of the co-invest, it's painful for me, and I'm sure for you, to put that money up. And it's very different in the case of others who have the ability to put up 10% because it's an institution. It's not coming out of their family's savings account.
I think it's coming out of the VC side.
Well, they're high velocity, high return.
No,
high
but
velocity.
for portfolio management, management of a portfolio company to have money in the game, I mean, I think that's maybe where it's coming from.
Yeah, and I mean, look, we're happy to put co-invest in. I'm sure FIA is as well. All of the TMOs are, but the VCs typically are worth, on average, as individuals, more than us in the Timberland investment community. So they do have the ability to put in a fair bit more, and then expect to get that out in 3 to 5 years, where we do not. So I think that's the challenge.
There's another question over there in the middle of the room.
Recognize this was largely between LP, GP interest, but thinking about the same sort of dynamic between third parties, and each company, each individual has its own sort of culture. Any tips or thoughts of how you guys have navigated infusing your morals, ethics into others?
Say that last thing again.
Morals, ethics, sort of standards into your third parties?
Yeah, so that's a great question. We rely very heavily on third parties, probably more than any other TMO. We were started under this TMO Light term. I think Tracy Evans came up with that back in the late 2010s. And we had to figure out what third parties aligned culturally with us and really thought the way we thought about our investors, and feeling like they were wearing our hat. And it took about 4 years for us to get that right. We went through a lot of third parties that we were not culturally aligned with. And that was painful, but obviously the more we've been around, the more we figure out who works well with us. And you can figure that out once you're working with these folks for 3 to 4 years. It's a good question.
Any other questions? Okay, well, thank you, Carter.
Thank you.